we'll bring up this question of how does the Crummey Trust compare to a 529 plan, and how do they contrast, and how do you use one versus the other, and how do you use them together?
Yeah. So Sahil brings up a good point. So a 529 plan is another pretty common way that people use their annual exclusion. And so you can use annual exclusion to basically, what a 529 plan is. 529 plan is an educational account that is income tax advantaged, and it's kind of like a retirement account but for education. And people typically fund them for little kids, and then they use them to pay for college, although you can also pay for high school, private school and stuff. But so how do they compare?
Well, what's the limitation? Maybe let's start with what's the limitation of a 529 plan?
Yeah. So there's a couple limitations to the 529 plan. So first of all, you wouldn't fund a 529 plan. If you fund it for a baby, you wouldn't fund it for 18 years until they go to college, because it would wind up with way too much money. So the assets in a 529 plan, they're tax advantaged, but you can only withdraw them basically for educational expenses. Congress just added a new small exception where you can take out a small amount for a retirement account. But basically, a 529 plan, the assets in the 529 plan are for educational purposes. And so typically people will fund them with maybe $60,000 or $70,000, but you don't need to give them $36,000 a year for 18 years, because you're going to end up with,
and what happened?
Investment returns way too much money.
So let's say someone ends up with, they fund it for 18 years, and they end up with $2 million in their 529 plan, and college is getting expensive. They end up paying $200K for their kids' college. What happens to that excess amount?
Yeah. So basically, the vast majority of that amount would be trapped in the 529 plan. It's at least in the current law, you'd have to try to transfer the account to another beneficiary who has educational expenses, but you couldn't use that money to buy a house. Yeah.
And so you can also there's retirement accounts that can come into play, but there's constraints on, right?
Yeah.
This is where go ahead.
Oh yeah. No, that's right. So there's a 529 plan. It often makes a ton of sense, and you might not be able to contribute to a Crummey if you're also contributing to a 529 plan, because they're sort of mutually exclusive to the extent that you're using your annual exclusion by funding the 529 plan. But you wouldn't be funding that for the beneficiary's entire life. You'd only be funding that for maybe 3 or 4 years. And so, either you fund the 529 plan for 3 or 4 years and then you fund the Crummey Trust, or maybe you decide against the 529 plan altogether, depending on your outlook. But they're not really totally mutually exclusive, because 529 plans tend to be funded only for a short amount of time. The other thing, sort of more directly address Sahil's question, it is a 529 plan, a tax advantage Crummey Trust. So the thing is, a 529 plan isn't that great from a gift and estate tax perspective, because there's provision in the gift tax that says that paying tuition doesn't count as a gift for gift tax purposes. And so 529 plans aren't really getting money out of your estate that you couldn't have gotten out of your estate anyways by just paying tuition directly.
It's a tax advantage, and I think that, just to be explicit, it's essentially the tax advantage growth is the real advantage. Because it's avoiding capital gains tax. Let's just assume you're investing it in long-term assets. You're essentially able to avoid the capital gains tax. But to Peter's point, because anyways, again, there's your lifetime gift exemption, there's your annual exclusion. You can then pay Crummey Trust taxes, but you could also pay your kids, grandkids, educational expenses on top of that. And so that money anyways could be spent towards that. You're not getting the tax advantage growth on that. And so, but that is a marginal piece relative to the 40% estate tax and those pieces on there.